let's kick off this deep dive. Today, we're cutting straight to AeroVironment, the defense tech leader. They just dropped their fiscal Q1 2026 results, and, well, the numbers look a little complex at first, but the story behind them, absolutely fascinating, especially with, a massive acquisition and that lifted earnings outlook. Let's unpack it. When you first glance at AeroVironment's Q1, it's definitely a bit of a roller coaster. I mean, revenue soared, right? Record $454.7 million. That's huge. 140% jump year over year. But then, boom, a GAAP net loss of, $67.4 million? And the non-GAAP adjusted EPS actually missed some analyst expectations, came in at 32 cents.
So yeah, for someone just scanning headlines, it looks mixed, maybe even concerning. What's really going on?
Yeah, it's fascinating because those headline numbers, especially that GAAP loss, they really don't paint the full picture, not the operational one anyway. The BlueHalo acquisition, done May 1st, that is the absolute game changer here. You have to see these results through that lens. I mean, BlueHalo alone, it brought in a staggering $235.2 million of that record revenue.
Okay, wow, right. So take that out for a second. AeroVironment's, let's call it legacy revenue, still grew a very respectable 16% year over year, hit $219.5 million. So yeah, the GAAP loss looks big, but we need to dig into why that happened. It's all tied to this huge strategic move, which is actually, a positive sign long term.
That context is crucial. And speaking of context, even with the GAAP loss and that slight non-GAAP EPS miss, I think FactSet analysts expected 33 cents, LSEG maybe 37, so 32 cents was a miss. Well, the market reaction was interesting. Shares actually climbed a bit in late trading. Seems like people were looking deeper. And here's the really big kicker for the future. AeroVironment lifted their full-year fiscal 26 earnings guidance significantly. They're now saying non-GAAP EPS between $3.60 and $3.70. That's way up from the previous $2.80 to $3 range, especially when a FactSet consensus was maybe only around $3.40 for the year. So the company itself is clearly very bullish.
Exactly, and that raises the key question, doesn't it? Why this big gap? You've got a GAAP net loss in Q1, strong revenue, but then this super optimistic guidance lift for the full year. The answer really lies in understanding the immediate and sometimes complex effects of that BlueHalo deal on the financials.
Okay, so unpack that for us. How does a really positive strategic acquisition, one that juices revenue like crazy, lead to a GAAP net loss? And how does that connect to their confidence about future earnings?
Right. So when a company like AeroVironment makes a huge acquisition, and BlueHalo was massive, $4.1 billion, all stock, you get these significant non-cash expenses. They come from something called purchase accounting. Think of GAAP, generally accepted accounting principles, as the official rulebook. It's super thorough. But sometimes, especially with big strategic moves like this, that official rulebook can temporarily make the underlying operational strength look, well, a bit blurry. That's why we also look at non-GAAP numbers. They strip out these specific, often non-cash impacts from the deal to give a clearer view. And here's the sort of counterintuitive part for you. Sometimes a loss on paper right after an acquisition signals huge future value is being added. In Q1, these non-cash expenses, mainly intangible amortization, hit the net loss by $79.7 million. That's 1.34 cents per share just from that.
Intangible amortization. What exactly is that in simple terms?
It's basically the accounting system spreading out the cost of the value you acquired that isn't physical stuff. Think patents, customer lists, tech know-how, brand reputation, even the skilled workforce from BlueHalo. These are incredibly valuable long-term assets. JAP rules say you have to account for their value decaying over time, like an expense.
Oh, okay. So it's like an accounting charge for the future value they just bought, not actual cash going out the door for operations this quarter.
Precisely. It's more like booking the depreciation on a massive asset you just acquired, an asset expected to generate returns for years. These are accounting adjustments, not really a reflection of how the combined business performed operationally in Q1. The acquisition also pushed up SG&A selling, general, and admin expenses. They rose by $97.5 million. But critically, look inside that number. $41.2 million was that intangible amortization we just talked about. Another $23.7 million was direct deal costs, think lawyers, bankers, plus integrating all of BlueHalo's people. And there was also a shift in the revenue mix. More services now, thanks to BlueHalo, which affects how gross margin looks too.
Okay, that makes sense. So if we sort of mentally strip away these big non-cash accounting things from the BlueHalo deal, the amortization, the one-time deal costs, what does the actual operational engine look like? This is where those non-GAAP numbers really shine, right? They show us the core day-to-day business health.
Exactly right. Look at their non-GAAP adjusted EBITDA. That's Earnings before interest, taxes, depreciation, and amortization, a good measure of operational profit. It actually increased, went up to $56.6 million from $37.2 million last year. That's a strong sign of operational health and the positive contribution BlueHalo is already making. CEO Wahid Nawabi pointed this out. He talked about continued strength across both our autonomous systems, AXS and space, cyber and directed energy SCDE segments. He mentioned record revenue and backlog, too.
Right. AKSS is their traditional drone business, and SCDE is the new frontier, largely BlueHalo driven, space, cyber stuff.
Pretty much. AKSS covers the advanced drones, robotics. SCDE is where you find things like secure satellite comms, directed energy, cyber. A lot of that cutting-edge capability came with BlueHalo. Revenue breakdown shows this. AKSS brought in $285.3 million. SCDE added $169.4 million. And you saw that revenue mix shift. Q1 was 69% product, 31% services. That higher service mix from BlueHalo often implies more recurring revenue down the line.
Got it. So BlueHalo brings massive revenue, expands capabilities into really hot areas like space and cyber, but the accounting for the deal makes the GAAP profit look rough temporarily. It's like buying a huge new factory. Lots of upfront costs on the books, maybe financing costs hit the profit line, but the factory's already running, boosting output, and setting you up for way more growth later. That clarifies why the market probably focused on the guidance instead of the GAAP loss. Much clearer now. Okay, so we've untangled the financials. We see a pretty strong core business boosted by this big acquisition. Now let's pivot to the future. What's giving them the confidence to maintain that strong revenue outlook, $1.9 to $2.0 billion, but raise the non-GAAP earnings guidance so much? What specific wins are driving this optimism?
Yeah, if you connect the dots, it looks like a really powerful mix. Strong execution, yes, but also some major strategic contract wins. And they're riding these huge tailwinds in global defense spending. A prime example really stands out is that nearly $240 million order they announced. It's for long-haul laser communications terminals. We don't know the customer, but they plan to put these systems into orbit. Louis De Palma at William Blair called it the largest laser communications contract we have seen.
Wow, okay.
Yeah.
Laser comms in space. That sounds like sci-fi stuff. Is this just faster internet for satellites, or is there a bigger defense angle?
Oh, it's absolutely a paradigm shift for defense. It's about secure, high-bandwidth data transmission. Imagine a network connecting satellites, ground stations, aircraft, completely resistant to jamming, almost impossible to detect.
Okay, that's huge.
For defense, that means instant, uncompromised intelligence, command, and control. Crucial for things like real-time missile tracking. We've historically used radio frequencies, right? Slower, much more vulnerable. Laser links are like invisible fiber optic cables floating in space, an almost impenetrable data highway. This big contract is a massive validation of the tech's maturity and its role in future defense systems. And De Palma did note these could be critical for initiatives like President Trump's Golden Dome for America concept for missile tracking satellites. AeroVironment already proved the tech works too. They had successful demos back in March, so they're ready.
Game-changing is right. Makes you wonder what else they have cooking in R&D. Any of the recent wins boosting this outlook?
Absolutely. It's not just the space lasers. They delivered the first 2 laser weapon systems to the U.S. Army. These are for counter-UAS, basically shooting down hostile drones. It's the first part of the Army's laser prototyping effort. So real deployable laser defense is happening now. And just last month, they delivered the first Group 2 P550 drones. These are larger recon drones for the Army's long-range reconnaissance program. Better battlefield intel. Plus, they're partnering with Sierra Nevada on an open architecture system for air and missile defense. That also ties into the Golden Dome idea, focusing on protecting specific sites like airfields. It shows they're really aligned with these major defense priorities.
Okay, so it really isn't just about buying BlueHalo. It's about what AeroVironment is doing with those new capabilities, integrating them, and winning these significant contracts that align with where defense spending is headed. They're actively capitalizing.
Exactly. And the numbers back it up. Their record backlog is now $1.1 billion. That's way up from $726.6 million just at the end of April. And Q1 bookings were strong too, $399 million, which beat estimates. They also mentioned $3.1 billion in unfunded backlog. That's potential future orders lined up.
That points to sustained demand.
Absolutely. Analysts see it too. Canaccord pointed out the Pentagon's FY26 budget has $9.4 billion for unmanned systems, $3.1 billion for counter-drone tech. AeroVironment is right in the sweet spot. Needham thinks they're uniquely positioned for industry-leading growth, calling the drone market a multi-year supercycle. And crucially, the company says its manufacturing is scaling up, and their portfolio, now boosted by BlueHalo, directly meets these global defense needs.
Yeah, the CEO, Wahid Nawabi, really emphasized that. He said they're exceptionally well-positioned due to their tech and their ability to scale manufacturing quickly for urgent customer timelines. It paints a clear picture. A company transforming, integrating a huge acquisition, and really positioning itself strategically. They even mentioned having 82% visibility to the midpoint of their full-year revenue guidance. That means most of this year's sales are already pretty much locked in. That's real confidence.
It is. Strong signal.
So wrapping this deep dive up, what we've really seen is a company skillfully navigating a massive strategic acquisition. Yes, it temporarily skewed the GAAP numbers because of accounting rules, but fundamentally, it strengthened their operational core, and boy, did it supercharge their future outlook. The integration of BlueHalo, these major new contracts in cutting-edge tech like laser bombs and weapons, all fueled by this booming defense market. It really seems to be setting AeroVironment on an exciting path, especially in autonomous systems, space, and cyber.
Indeed. And it really highlights how vital it is, especially during big M&A activity, to look beyond just the top-line GAAP figures. You have to understand the why behind the numbers. In this case, shifting focus to non-GAAP metrics gave us a much clearer, more accurate picture of the underlying business health and, frankly, its impressive future potential. We see the operational strength, the innovation.
Which leads to a final thought for you, our listener. As defense tech races ahead, evolving so rapidly, how can digging into these sometimes complex financial reports actually help us understand more than just a company's past performance? How can it help us anticipate the future shape of innovation, and maybe even the future of global security itself? Something to think about. Thanks for joining us for this deep dive.